The silver market just shattered. Not figuratively. Literally. And if you don't understand what happened in the last 24 hours, you're about to get blindsided by what comes next. We're not talking about a regular correction here. We're not talking about healthy profit-taking or technical consolidation. We're talking about physical silver trading at a 37% premium to paper silver. We're talking about $1.1 trillion in market cap vanishing, while Shanghai buyers are paying $36 over spot just to get their hands on actual metal. We're talking about the largest disconnect between paper and physical markets in the entire history of commodity trading. And we're talking about a potential Federal Reserve announcement happening today that could either validate everything we've been saying for years or prove that the manipulation machine still has one more card to play. By the end of this video, you'll know exactly which technical levels are about to determine silver's next move, why this crash is different from every other crash in history, and what one specific political appointment could mean for the complete destruction of the paper manipulation system. This is not clickbait. This is not hype. This is the data, the charts, and the cold hard truth about what's happening right now. I'm Marcus Stone, and you're watching Metal Truth Analysis. Let's start with the numbers because the numbers don't lie, even when the market does. Silver has crashed 22% from its record high, down 17% in just the past 24 hours. That's not a typo. 17% in one day. Currently trading at $95 on ComX after touching highs of $121 just days ago. Gold has collapsed back below $5,000 per ounce. The precious metals that are supposed to be your insurance policy, your safe haven, your protection against chaos, just experienced the kind of volatility you'd expect from a speculative cryptocurrency, not from a 5,000-year-old store of value. $1.1 trillion erased from silver's total market capitalization, $4 trillion erased from gold in the same 24-hour window. These are liquidation-level moves. These are forced selling cascades. These are margin calls hitting leveraged traders like a freight train, stop losses getting triggered in waves, and weak hands capitulating in absolute panic. This is the kind of price action that destroys accounts, wipes out years of gains, and makes people swear they'll never touch precious metals again. But here's the thing that should make everyone stop and think. While all of this carnage is happening on the paper markets, while ComX silver is getting absolutely demolished, the physical market is telling a completely different story. And that story is about to blow your mind. Before we get into the physical paper disconnect that everyone needs to understand, let me show you something that's going to establish credibility for everything else we discussed today. In our previous video, and if you haven't watched it, the link is in the description, go back and see this for yourself, we laid out specific technical levels that would determine silver's trajectory. We weren't guessing. We weren't throwing darts at a chart. We identified exact price zones based on tested technical analysis, and those levels are now playing out in real time with stunning accuracy. We said the 150-hour exponential moving average would be the critical support level to watch. We told you to add it to your charts. We said if this EMA holds, we get a bounce. If it breaks, we cascade lower to the next support zone in the low 90s. And that's exactly what happened. Initially, the 150-hour EMA held. Price bounced 10% off that level, rallying from $108 all the way up to $117. Everyone who was watching that specific level, everyone who understood the technical setup, had the opportunity to catch that move. That's a 10% gain in a matter of hours for traders who were paying attention. But then selling pressure intensified. The EMA broke. And when it broke, we didn't wonder where price would go next. We already knew. We had identified the $90 to $95 support zone as the next critical level. And that's exactly where we are right now, testing the very zone we identified before this crash even happened. If this level holds, we can move higher. If it breaks, our next target is $86, which represents a major historical support level and a potential capitulation zone. I shared this analysis live on X as it was happening. If you're not following me there, you're missing real-time chart updates, data drops, and analysis that I can't always post in video format. The handle is Metal Truth Analysis on both X and YouTube. It's verified, so ignore any imposter accounts trying to scam you. I don't sell courses, I don't sell signals, I don't sell anything. This channel exists to provide unbiased information and empower you to make your own informed decisions. Your engagement drives this content. Comment below and tell me where you're watching from and what you think silver does next week. I read every single comment, and your questions shape future videos. Now let's get into the part that changes everything. Here's what's happening that the mainstream financial media is completely ignoring, and this is the single most important thing you need to understand about this entire situation. While ComX silver, paper silver, futures contracts, derivative products is trading at $95 per ounce, Shanghai silver, physical silver, actual metal that you can hold in your hand, is trading at $131 per ounce. Read that again. ComX, $95. Shanghai, $131. The Shanghai premium just hit $36. That is the largest premium between physical and paper silver in recorded history. We have never seen anything like this. Physical silver in China is trading at a 37% premium over paper silver in New York. Let me put this in perspective for anyone who doesn't understand why this is absolutely insane. In a normal, functioning market, prices converge. If there's a price difference between two markets for the same asset, arbitrageurs jump in, buy in the cheap market, sell in the expensive market, and the prices equilibrate. That's basic market mechanics. That's how efficient markets are supposed to work. But that's not happening here. The premium isn't converging, it's expanding. It just hit an all-time record. And that tells you something is fundamentally broken in the price discovery mechanism for silver. Paper silver is saying, silver is worth $95 and we're in panic selling mode. Physical silver is saying, we will pay $131, a 37% premium, just to get our hands on actual metal because we know the paper price is complete fiction. One of these markets is lying. One of these prices is real, and one is manipulated. And the physical market, the market where actual metal changes hands, where real supply meets real demand, is screaming that the true price of silver is nowhere near $95. Now let's talk about something that should make any rational investor question everything they think they know about precious metals pricing. The gold to silver price ratio just hit 51 to 1. That means gold is trading at 51 times the price of silver. You need 51 ounces of silver to equal the price of 1 ounce of gold. Now let me show you why that number is completely disconnected from reality. The mining ratio, how much silver is actually mined compared to gold, is 8 to 1. For every single ounce of gold that comes out of the ground, 8 ounces of silver are mined. 8 times as much silver is produced as gold. The ComX vault ratio is 12 to 1. For every ounce of gold sitting in ComX vaults, there are 12 ounces of silver. The LBMA inventory ratio is 3 to 1. For every ounce of gold in London Bullion Market Association vaults, there are 3 ounces of silver. So let me get this straight. We're mining silver at 8 times the rate of gold. We're storing it at 12 times the rate in ComX vaults. But it's trading at 1/51st the price of gold? Does that make any sense to anyone? If supply and demand actually mattered, if fundamentals actually drove price, shouldn't the price ratio be somewhere closer to the mining ratio or the vault ratio? Shouldn't silver be far more expensive relative to gold than it currently is? And here's the kicker that makes this even more absurd. While the price ratio is expanding, while silver is getting cheaper relative to gold, the physical vaults are being drained. ComX silver inventories are declining month after month. LBMA inventories are under pressure. Shanghai is pulling physical metal east, paying massive premiums to do it. Inventory is declining, demand is surging, and the price is crashing. Connect the dots. This is not how free markets work. This is manipulation, and the manipulation is getting more obvious by the day. So what actually triggered this crash? Because the timing is extremely suspicious, and when you look at the sequence of events, some very interesting questions emerge. According to multiple reports, gold and silver prices started falling at the open of trading in China. Then, conveniently, the London Metal Exchange announced it was experiencing technical issues and delayed its opening. Technical issues. Right. Silver got smashed $20 from $115 down to $95, right as the LME delayed its open due to these mysterious technical problems. The LME, one of the world's largest metals exchanges, just happens to have technical issues at the exact moment that would allow maximum damage to silver's price with minimal resistance. I'm not saying it's definitely manipulation. I'm saying the timing is awfully convenient for anyone who wanted to push the price lower without immediate physical delivery pressure from London buyers. There's not much fundamental news driving this sell-off. No major economic data. No geopolitical resolution. No supply glut announced. The only significant event on the calendar is today's expected FOMC chair announcement by President Trump. And that brings us to the catalyst that could change everything. If Trump picks a conventional Federal Reserve chair, another Jerome Powell type, another establishment economist who believes in unlimited money printing and flexible monetary policy, then the markets might stabilize at these levels or continue selling off. The manipulation machine continues. Business as usual. But if Trump surprises everyone and picks Judy Shelton as Fed chair, we could see one of the most dramatic intraday reversals in precious metals history. And more importantly, it would mark the beginning of the end for decades of price suppression in gold and silver markets. Let me explain who Judy Shelton is, and why her potential appointment would be an absolute bombshell for the banking establishment. Shelton is an economist, a former Trump Federal Reserve nominee, and one of the most outspoken advocates for sound money in modern economics. Her ideas don't just challenge current monetary policy, they challenge the entire foundation of the fiat currency system. She advocates for a return to the gold standard to curb inflation and control government debt. She has proposed the creation of gold bonds as a transitional mechanism to reintroduce sound money gradually. Her economic philosophy represents a direct threat to the Federal Reserve's ability to print unlimited amounts of money to bail out banks and inflate financial markets. Let me break down what a gold standard would actually mean. Under a gold standard, the value of the dollar is tied to a fixed amount of gold. The government can't just print money out of thin air whenever it wants. Money creation is limited to the gold reserves the country actually holds. This means inflation is controlled because you can't dilute the currency without acquiring more gold. Government debt can't spiral out of control because spending is restricted by real resources, not just political will. Monetary stability is restored, giving individuals and businesses confidence in the long-term value of their money. When Trump nominated Shelton to the Federal Reserve Board in 2020, her candidacy faced intense resistance from the banking establishment, from mainstream economists, from Wall Street. Why? Because her ideas would end the game. They would end the ability of central banks to manipulate markets through unlimited money printing. They would force accountability. They would tie monetary policy to something real instead of the whims of unelected bureaucrats. Her nomination was blocked by a narrow Senate vote. But her ideas haven't gone away. In fact, they've gained traction as inflation has ravaged purchasing power, and government debt has exploded to levels that would have been unthinkable a generation ago. Recently, Shelton has proposed gold bonds as a stepping stone towards sound money. Here's how it would work. The U.S. Treasury would issue bonds denominated in gold, not dollars. Investors could purchase these bonds and redeem them for actual gold at maturity, completely bypassing the risks of fiat currency devaluation. This system would create a parallel market tied to real value. It would encourage fiscal responsibility because the government would have to maintain gold reserves to back these bonds. It would offer investors a hedge against inflation without requiring them to physically store gold. And most importantly, it would lay the foundation for a gradual transition back to sound money without causing a complete systemic collapse. Gold bonds wouldn't replace the dollar overnight, but they would create competitive pressure. If people could choose between holding dollars that lose value through inflation or holding gold-backed bonds that maintain their purchasing power, which would they choose? The market would decide, and that competitive pressure would force monetary discipline. If Trump picks Judy Shelton as Fed chair today, it would signal a fundamental paradigm shift in U.S. monetary policy. It would be a declaration that the era of unlimited money printing is over. It would be a direct assault on the paper manipulation machine that has suppressed gold and silver prices for decades. The implications would be enormous. The derivatives market that allows banks to short massive amounts of paper gold and silver would face an existential threat. The concentrated short positions held by a handful of bullion banks would be under direct policy attack from the Federal Reserve itself. The decades of price suppression would be acknowledged and dismantled. That's why today's announcement matters. That's why the timing of this crash is so suspicious. That's why silver got hammered right before a potentially game-changing Fed chair selection. The banking establishment wants you to believe that $95 is the real price of silver. They want you to think this crash validates their narrative that precious metals are volatile, unreliable, and not worth holding. But a $36 Shanghai premium is telling you the real price. A 51-to-1 gold-silver ratio against an 8-to-1 mining ratio is telling you the real price. Vaults being drained while the paper price crashes is telling you the real price. Let's get back to the technical analysis because regardless of what happens with the Fed chair announcement, we need to understand the price levels that will determine silver's next move. As I mentioned earlier, we laid out these exact levels in yesterday's video, and they're playing out with precision. The 150-hour EMA held initially. We got that 10% bounce from $108 to $107. Then, selling pressure overwhelmed the buyers, and the EMA broke. Once it broke, we said the next support zone was $90 to $95, and that's exactly where we are right now. This is the critical test. If this support zone holds, if buyers step in at these levels and defend 90, we can see a reversal and a move back higher. If this support breaks, the next major level is $86, which would represent a deeper correction and potentially a final capitulation move before the physical reality overwhelms the paper fiction. The technical roadmap is clear. Watch $90 to $95. That's the line in the sand right now. But here's what's different this time compared to every other silver crash in history, and this is crucial for understanding why this might be the bottom. The difference. Physical is not following paper. In past silver corrections, 2011, 2013, 2020, when the paper price crashed, the physical market followed. Premiums would compress. Sometimes they'd even go negative as panicked physical holders tried to sell their metal. Coin dealers would lower their premiums. Buyers would step back and wait for lower prices. Not this time. The physical market is not following the paper market down. In fact, it's doing the exact opposite. Shanghai premium, $36. That's not compression, that's expansion. That's not panic selling, that's panic buying. Physical buyers in Asia are paying 37% over ComX spot price just to get metal. They're not scared. They're not waiting. They're buying the dip with both hands because they know this paper price is fiction. They understand what's happening. They see the vault inventories declining. They see the mining ratios. They see the industrial demand that's non-negotiable. They see the coming supply squeeze. And they're willing to pay massive premiums right now to secure physical metal before the disconnect becomes so obvious that the paper pricing mechanism collapses entirely. Every dollar the banking establishment pushes the paper price down, the Shanghai premium expands. Every ounce they short on ComX, the physical market absorbs and demands delivery. Every raid they conduct, Asian buyers step in harder. They're losing control, and they know it. Now, let's talk about the very real risks here, because after a 22% crash, we need to be completely honest about what could happen next. We're down from $121 to $95. That's a massive correction. The technical damage is real. The momentum has shifted bearish in the short term. If the $90 to $95 support zone breaks, we could see $86 or even lower. The charts don't lie, and right now the charts are not bullish. If you were trading silver on leverage, if you had tight stop losses, you got stopped out. You got liquidated. The volatility is simply too extreme for over-leveraged positions. A $1.1 trillion market cap erasure in 24 hours is a liquidation cascade. Margin calls hit. Forced selling happens. Weak hands panic. That's the brutal reality of trading in this environment. And here's the other risk. If Trump picks a conventional Fed chair instead of Judy Shelton, if there's no policy shift toward sound money, the paper manipulation could absolutely continue. The banking establishment could push silver even lower. We could see more technical breakdowns. Lower levels could be tested before the physical reality finally forces price discovery. Bitcoin is also getting crushed, down to a 2026 low of $81,200, down 6.3% and looking weak. Crypto is selling off. Stocks are weak. Gold is below $5,000. Everything is getting hit. If this is a broader risk-off move, if liquidity is tightening across all markets, precious metals could get dragged lower in the near term despite their status as supposed safe havens. These are real risks. I'm not going to sugarcoat them. If you're over-leveraged, this market will destroy you. If you're trading on margin, you need to understand that another 10% down move could wipe out your entire position. But here's why these short-term risks, while real for traders, don't change the structural thesis for physical metal holders. The $36 Shanghai premium is the largest in history. That's not a sign of weak demand. That's a sign of desperate demand. Physical buyers are willing to pay 37% over paper spot just to get actual metal. They're front-running the squeeze because they understand what's coming. The 51-to-1 gold-silver ratio against an 8-to-1 mining ratio is screaming that silver is massively undervalued relative to gold. When this ratio gets stretched this far, history shows it snaps back violently. Silver outperforms gold on the rebound, sometimes dramatically. And we're at one of the most extreme ratios in modern market history. The vaults are being drained. ComX inventories are in decline. LBMA inventories are under pressure. Shanghai is pulling metal east, paying record premiums to do it. The physical market is tightening while the paper market is crashing. That divergence cannot last indefinitely. One of two things will happen. Either the ComX price rises to meet Shanghai, or the ComX pricing mechanism loses all credibility and Shanghai becomes the global price setter for silver. There is no third option. The divergence resolves one way or the other, and here's what validates this entire analysis. The technical levels we identified in yesterday's video are playing out in real time. The 150-hour EMA held, gave us that 10% bounce to 117, then broke. We said if it breaks, early 90s is next. We're testing $90 to $95 right now, exactly as predicted. The technical roadmap is proving accurate. The fundamental analysis of the physical market is being confirmed by exploding premiums. The structural case for silver hasn't changed. It's actually gotten stronger because the manipulation is becoming more obvious and more unsustainable with each passing day. Let me give you the 3 critical takeaways from everything we've covered, and then we're out. Number 1. The technical levels from yesterday's video are playing out with precision. The 150-hour EMA held initially with a 10% bounce, then broke. Price dropped to the early 90s exactly as predicted. Now we're testing the $90 to $95 support zone. If this holds, we move higher. If it breaks, $86 is the next major level. The technical roadmap we laid out is unfolding in real time. Follow the levels. They're working. Number 2. The physical paper disconnect just hit an all-time extreme. Shanghai premium at $36, gold-silver ratio at 51-to-1 against a mining ratio of 8-to-1. Vaults draining while the price crashes. This is not a broken market, fundamentally. This is paper manipulation meeting unstoppable physical demand. The banking establishment is shorting into shortages, and that will only worsen the squeeze when it finally comes. The physical market is telling you the truth. Listen to it. Number 3. Trump's Fed chair announcement today could be the catalyst that changes everything. If Judy Shelton is selected, her advocacy for the gold standard and gold bonds represents an existential threat to the paper manipulation machine. It would signal a policy shift towards sound money and away from unlimited money printing. If a conventional chair is picked, the battle continues, but the structural issues in the silver market remain. Either way, watch today's announcement closely. It could be historic. Here's the unresolved question that will determine the next major move. Does the $90 to $95 support hold, or does it break? If it holds and we bounce, does a Judy Shelton Fed chair pick accelerate the move higher and ignite a short squeeze? Or do we see more technical damage with a break to $86 before the physical reality finally overwhelms the paper fiction? We're at a critical inflection point. The technical levels we called are being tested right now. The physical market is at maximum divergence from paper. A potential policy bombshell could drop today that validates everything sound money advocates have been saying for decades. Stay sharp. Watch these levels. Watch the Fed announcement. The next move could be historic. Do your own due diligence. Understand the risks. If you're over-leveraged, this volatility will destroy you. If you're building a physical position and you understand what's happening structurally, this could be the final shakeout before the real move begins. Time will tell. Invest with logic, not with hype. Question everything, including what I'm telling you. Verify the data yourself. Make your own informed decisions. This is Marcus Stone with Metal Truth Analysis. If this analysis helped you, hit that like button, subscribe for daily precious metals coverage, and drop a comment below with where you're watching from and your price prediction for silver next week. The truth is in the data. The manipulation is real, but the physical market always wins eventually. Stay vigilant. We're out.